with you. Apropos of what Stephen was saying, I think arguably, I've been through more economic cycles than most of you, perhaps all of you. And it's very interesting because the ability to manage money well depends on several factors. Experience is a big issue, so is knowledge and obviously talent, but it's all a matter of probabilities. What's the likelihood of certain things happening? But we all grew up with the idea that the determinants of valuation come down to basically three things: the outlook for interest rates, the outlook for inflation rates, and the outlook for corporate earnings. And everything we look at and study feeds into those elements. So right now, what we are looking at, and we're all witness to it, is an enormous tech revolution. Tech revolution, which has been accelerated by the pandemic, the tragic pandemic that's been sweeping the world. But at the same time, we have developed the skills, the ability to produce technology that has characteristics that none of us has ever experienced before. We're seeing it, for example, in the breakthroughs of the creation of the vaccine. You probably all know it took 2 days to figure it out, which would have taken years. And the ability to have breakthroughs, medical breakthroughs, which will have a major element in people's ability to deal with disease, to prevent disease, which obviously also is a threat to pharmaceutical companies' patent positions, because one of the things they see is that if you can come out with a cure for something that they have a patent on, if that cure becomes effective, then the medicine they've developed that's patented becomes much less important. And so we see the acquisitions, for example, of biotech companies by major pharma to protect that position. Now, this has never happened before. When you came up with a breakthrough drug, you had patent protection. That was wonderful. But now, with the technology we have today, we can come up with preventives and cures that we never have done before. Coming back to what I started with, the outlook for inflation, interest rates, and corporate profits. The central banks of the world have never, ever been as accommodative. We have negative rates, you all know, in Europe. We've got real rates in the United States that are negative. We have the Federal Reserve. Do you remember the balance sheet of the Fed 12 years ago? 10 years ago was $975 billion, which today is over $7 trillion. And those who are concerned about the level of US debt, rightly concerned, have to factor in that the real cost of the debt is the cost of maintaining the debt, service the debt. It's the interest rate. And interest rates now are a fifth or so of what they used to be. So we can support a much higher level of federal debt. And now that's very important to the fundamental outlook for infrastructure spending. But let me just say that the total balance sheets of the developed world now are in excess of $22 trillion. And so there is this constant concern about an increase in inflation. The antidote to inflation, which you are all aware of, is productivity. Productivity today is being enormously enhanced by technology. We can manufacture automobiles, for example, with hundreds of people instead of thousands of people. The introduction of new technology is the cause of productivity increases. And those productivity increases represent a powerful antidote for inflation, because of the ability to substitute higher cost ways of doing business with lower cost ways. So we are in the midst of an important, major technological revolution. Take, for example, Apple. Apple has outstanding something like 900 million plus phones. With a new technology today, most of those phones are being obsolesced. It will not surprise us if this year, including the fourth quarter of last year, would represent a demand for iPhones exceeding what had been Wall Street's estimates significantly. We can see next year, well, I should say 2021, we should see in excess of 230, 240 million phones sold globally. Now, the ability to, and you will remember when phones came out with very little memory. Today we have 250 gig memory. We're going to 512. We're going to 1024. When you superimpose 5G, we're going to be able to do things much more rapidly in a matter of seconds that took minutes. But this tech revolution now affects every company that serves the ability of Apple to put out these types of products. Now, the argument that we make is the fact that we're now producing 5 nanometer chips. I don't know how many of you are familiar with 5 nanometer or 10 nanometer, but the width of one of our hairs can run 80,000 nanometers. So we're talking about virtually microscopic circuits. What this does is enable battery power to be effective, more effectively used. We can have much more sophisticated computers in a phone. But the problem is, or the opportunity is, that those companies that are producing those chips, for example, Taiwan Semiconductor, it costs $15 billion to build a plant. It takes 2 years or more. The ability to produce these kinds of chips is very restricted. It's very costly. So the value of the companies that are in this area become quite significant. Competition cannot enter the area of production with any kind of ease. It takes enormous expertise. It takes enormous capital. It takes enormous science. And if any of you have ever been in a clean room, it's fascinating to see how this process unfolds. I recently drove again a Tesla. I don't know how many of you had experience with a Tesla. It's a computer on wheels, the most sophisticated chips, thousands of dollars of technology in one car. All the car manufacturers are going to electric vehicles. Electric vehicles require power, charging. How do we charge? The electric grid in the United States is insufficient to handle the demand that's going to come from the proliferation of electric vehicles. Just think about the fact that every house that has an electric vehicle, every home is going to want charging capability. Has the grid the ability to handle it? There are in the United States in excess of 1 million service stations. Each service station has multiple pumps. We're not going to want to be dependent on service stations just to charge a car, as an example. So home building, all home building will have options, does have options today, to put in 220 volt charging capability. This means that the infrastructure, which is a big theme for us, not only in the electrical grid, but across the board in the United States. As an aside, I would just tell you, we have in excess of 600,000 bridges in the United States, of which no fewer than 150,000 need to be urgently repaired. Infrastructure needs in the country are enormous. We see reports that total $4 trillion of expenditures to fix the infrastructure. So when we look at electric vehicles, when we look at the movement to alternative energy, all of this requires sophisticated technology. So we're in the midst of a revolution in technology, not unlike the industrial revolution that took place in the early part of the 20th century, but bear in mind, this is happening more rapidly and it's global. And the consequence of it is that there is enormous capital spending that will continue to go into this area. Now, a few weeks ago, we read about the big cyber attack on the US government. We do not have a cybersecurity system that is dependable. The amount of money that was estimated to go into cybersecurity involved a growth rate of 8 to 10% per year. That number is now running in excess of 20%. The amount of money just for some aspects of protecting the cloud, because as you probably know, 33% of everything we do is in the cloud. That's estimated to move to 50 to 60% in the cloud. That means the security for the cloud has to be beefed up enormously. The amount of money estimated for that is at least $200 billion. One of the very important elements in investment thinking is always to ask ourselves, where does capital flow? Where must capital flow? Cybersecurity, alternative energy, these are not independent. These are independent of GDP. Whether GDP is up or down, capital spending in these areas will continue apace. That represents then the opportunity to analyze companies that serve these industries with a degree of reliability of earning power, which determines the valuation, that is greater than if it were totally GDP dependent. So when we look at applications of technology, whether it's in infrastructure, and infrastructure requires an enormous amount, whether it's in biotech, which requires enormous amount of technology, all these breakthroughs, whether it's in communications, the network is insufficient in the United States. We have too many people, we have students, education. We talk about putting money in education. What does that mean? Students don't have devices. They don't have access to the internet. We need to spend money to create much more bandwidth. We ourselves, when we're on Zoom calls or we'll lose a call or it's freezes, we do not have adequate investment in that area. This represents enormous investment opportunity for us, for all of us, to select those companies that are the prime beneficiaries of these forces, of these trends. And this leads then to the question of evaluating their earning power, their managements, their competitive positions. And the result of that is that you can generate investment returns in a zero, virtually zero investment environment of interest rates, which then gives us capitalization rates, which we're now seeing in the market, which enormous prices relative to earnings, relative to revenues. You say, how do you justify some of these valuations? And then people we go back to the year 2000 when we had the big bubble and the bubble burst, and we say, well, now we're in that kind of a situation today, perhaps. The answer to that is categorically no, in our opinion. The reason for it is that today's technology is affecting every single industry. In 2000, what did we have that drove 2000's bubble? We had the development of the internet, we had cell phones, and we had Y2K. Those of you who remember the problems of Y2K, we had to get new devices. We had those three elements that created the bubble when everybody got so excited about it in 2000. Today is no comparison to that, because there is no industry that we can point to that is not going to have to continue to invest sums in technology, in cybersecurity. And cybersecurity, let's just be clear about it. We are in a cyber war. We are able to do things and have the things done to us that have never existed before. And because we are so woefully lacking on government level, state government level, local government level, individual level, that this is a huge investment requirement, an investment need, and then we need to find the companies that are the prime beneficiaries of those forces. So this is one of the most exciting investments that I have lived through in the 60 years. Can't believe it, 60 years that I've been through this. But I often hear questions, how can we afford it as a country? How can we afford to invest on the government side? How can we run these deficits, et cetera? Well, the reason for those questions is because in the past we couldn't. In the past, we had a different type of economy. In the past, we had 5, 6, 7, 8% interest rates and more. We don't have that today. So the effect of having capital at such a low cost and capital interest rates are the oil for the circulatory system of money. The higher the rate goes, the more difficult it is for capital to flow broadly. It has to become more selective. With very, very low rates, capital can flow almost anywhere, and anywhere that makes good economic sense. And so this is a secular situation for us, which represents unparalleled investment opportunities that we have not seen any time in our lifetimes. And this is not going away next year or in 2 years, et cetera. And part of the reason why it's not going away is what I mentioned earlier about chip development. It used to be that we, not too long ago, we were making 14 nanometer chips. As you probably know, Intel has lost its ability to make 10 nanometer, 5 nanometer, 3 nanometer. So Intel's had some problems because of that. But because the technology itself is advancing at such a rapid rate, the need to upgrade, the need to substitute the latest technology is so prevalent that continues the secular trend of this cycle for many years down the road. Now, from a point of view of cost of the country, the United States, to support an infrastructure program of large spending, remember two things. Number one, the technology revolution is having a major impact on medical treatment. We do robotic surgery at much lower cost. Invasive surgery has enormous advances. Just think about the fact that we spend in the United States $3.5 trillion a year on healthcare. 3.5 trillion. What happens when we can save 500 billion of that as a number, as an example of how much more efficient we can be with medical technology? Therefore, the cost of medical care can go down, productivity increases, people are healthier, more productive, lifespans expand, the labor force benefits from that, and all of that then creates more economic activity, which yields bigger tax receipts for federal, state, and local governments as we have more employment and more economic activity. So we're in a period where so many positive things are going to continue to develop as a result of this technology revolution, that the investment opportunities in a almost zero rate environment are unheard of. They're unparalleled. We haven't lived through it. And yes, rates can go up. They can go up a little, obviously, but the problem with the argument that rates can go up a lot is that as soon as that happens, we're going to have a slowdown in economic activity. As soon as that happens, rates start to go down again. So we are not in a secular trend of rising cost of capital. Quite the contrary. At this point, maybe I should stop here and open it up for any questions. I would just add one thing. Green energy, very important, right? Whether it's wind power, whether it's solar power. The fact is that every major oil company in the world is redirecting its capital spending from oil and gas discovery, development, production, to alternative energy. Upwards of $100 billion just from a few major oil companies is being redirected to alternative energy. So the capital that's coming from that sector alone is having an impact and will have an impact on all the companies that benefit from the substitution of alternative energy for fossil fuels. So at this point, it's probably appropriate for me to stop. And if you have some questions, I'd love to field them.
Thanks, Arnold. That was great, as usual. So many of you, this is your first time hearing Arnold speak. Some of you have heard him on his on the ARS Zooms, but let's we're an interactive crowd here, so let's get the questions going.
Hi, Arnold. This is Jim Flipkowski. Thank you for your thoughts. I really appreciate it. So I'm in the steel industry, and I've been in the steel industry now for about 12 years. And with every new administration, I've heard great ideas and great thoughts about an infrastructure bill that's going to be passed. And I think when Barack Obama became president, he had the shovel ready that really was repaving roads. And they found out they didn't have a lot of shovel ready jobs to do. And then there's always the how much and over what period of time, and some ideas that were floated were good in the macro, but every year and you break it down, it wasn't that much. And seems to be a real short-term focus on where money is spent. So I agree with you on the infrastructure, but how realistic do you think, given our history, track record of being able to get something done?
Yeah, thanks a lot for the question. It's it's a singularly important question. Our feelings are twofold. Number one is that a lot of the projects that we've talked about over the past 10 years were postponable. You get away, well, okay, we're not going to do this, we're not going to do that. We now have so many areas that are no longer postponable. If we want to remain a competitive nation, no longer postponable. But now the question comes, if we have such terrible partisan fights in Congress, and we're going to have a new administration, how is any of this going to get done? President Trump, when he came in, wanted an infrastructure program, but that never came to pass. The question then, and we've heard this before, how do you expect them to get anything done, spending this money, deficit spending? The answer for us is not complicated. Because the infrastructure needs are so intense, so great, and because of climate change, they are not postponable because there's been so much damage done. Every representative in Congress, every congressman, every congresswoman, every senator is in a jurisdiction that requires infrastructure investment. Every one of them is representing people that need investment in their jurisdictions. So we're going to go back to old-fashioned deal-making in Congress across the aisle. You have a project you need. I have a project I need. We're opposite sides on the aisle. We will vote. I will vote for your project. You need to vote for mine, and let's get it done. And that's how it's going to get done. And as far as shovel ready is concerned, because of the advances in technology, what used to take a much longer time to do can arguably be done in a much shorter time, depending on the nature of the project itself. But when we do this, we have the ability also to train people where the labor force needs to be upgraded. That's an investment in education. All of this can come to pass, and in our view, it will come to pass if the United States is going to remain a first-rate nation. And it's not postponable, and it's politically achievable because of the needs in every representative's jurisdiction. I hope that answers the question.
Yeah, that was terrific. Thank you. And I guess I could say amen, or what was it last night? A woman?
Right.
Other questions, comments?
Arnold, I'll put Stephen on the line. He said you have a view on the dollar as a reserve currency. Love to hear that. if you'd like to tell us.
Sure, be happy to. Let's agree that it is not feasible. It is not feasible to have a reserve currency controlled by a dictatorship. Would you agree with that?
Yes, absolutely.
Okay. That eliminates China, which is the second largest economic nation. A reserve currency has value to the degree that the country that has the reserve currency is able to be very productive. If the United States were to lose its productive capacity, we will lose an important element in our reserve currency status, which would be the exchange rate. If we lose our productive capacity, our exchange rate will deteriorate, and we will be importing inflation. We will be unable to deal with the needs we have. Therefore, and when you see the dollar now weaker against the euro, for example, we are in a less advantageous position productively than some of the other democracies. But there's nothing wrong with the dollar fluctuating. We've had periods of much more dollar weakness. I remember 7 years ago, the euro dollar exchange rate was $1.45. So now it's $1.23, $1.22. So I don't see how any time in the short term our currency loses its reserve status. And remember that the currency is a relative concept. What's the alternative? Is it the euro? Is it the yen? There is no other alternative unless you go to a cryptocurrency. And the cryptocurrency problem is that it's a computer, it's fixed in amount, it's insufficiently large for a trading currency. It's bearer paper in effect. There's no way of tracing, and if you lose a password, you can't access it. The dollar as a reserve currency, in our view, will remain a reserve currency. The exchange rate will fluctuate, and if we become more productive, the dollar will become stronger relative to other nations. So if you want a store of value away from the dollar, you have two ways of looking at it. One is you could diversify into precious metals or hard assets, a different type of hard assets, real estate. But essentially for us, the dollar will not lose its reserve currency status. It will fluctuate.
Thank you.
Arnold, there was one question, I think, from Los Angeles. Ken, do you want to ask a question?
Yeah, question, Arnold. First of all, it's always amazing to hear you speak, so thanks for that.
Well, thank you.
In terms of the infrastructure, do you guys have are there any opportunities now for investment into that space? And extra credit, are there any opportunities in opportunity zones in the US to invest in that space?
Absolutely, there are opportunities. And, infrastructure and alternative energy are also closely related. Did you see, I don't know, a couple of days ago, New York Times had a front page article in the business section about wind power from General Electric. I don't know how many of you saw that. That also relates to infrastructure, because if we can produce more energy through alternative means, and we're going to be energy short with all of the proliferation of energy, of electric vehicles and other devices. So the two are really linked, closely linked. So I would tell you, yes, there are any number of companies that are direct beneficiaries today. We own one or two of them. They tend to fetch very high valuations at a time when they get discovered. And you're going to see also companies diversifying into that area. So part of that is an element. You take that General Electric article, for example. Anybody who read it, if it occurs to you that GE at some point may spin that business off, you're going to have a pure play in alternative energy. That and if General Electric has figured it out, and I'm sure they have figured it out, what that would do to the valuation of General Electric, it could be quite significant. So it's important to recognize that companies that have the expertise that can develop products in that area will, in and of themselves, develop divisions that will directly benefit, and then they're going to have the financial opportunity to say whether they're going to keep it under the umbrella of the corporation or split it up. The same thing is happening, by the way, in cyber. As you probably all know, IBM is going to be splitting up this year. IBM just announced the purchase of Expertis Technologies, which is a major part of the SWIFT system, the Society for International Financial Transactions. Expertis does $50 billion of transactions per day. IBM has an important cyber division. IBM splits up because they want an independent company that's fast growing and not have the whole corporation be retarded in its valuation because they own too much legacy business. And in the meantime, IBM, interestingly enough, has a yield of 5%, which is a secure dividend and highly competitive in a very low rate environment. So we're seeing good managements, very high quality managements, looking at the opportunities to invest in these other areas. And IBM, by the way, has a cyber enforcement division, which also has some interesting opportunities. So all of this is to underscore the vibrancy of our corporations, and the capital markets are able to so easily accommodate opportunity because they flow so easy. There is no obstruction in the blood system, in the circulatory system, that would exist if interest rates would be much higher than they are today. That's an important concept. Low interest rates, a free-flowing capital system, freer flowing. And the higher the rates go, the less free-flowing capital will be.
So, Bill, I see you off mute. You want to ask a question?
Sure. Yeah, Arnold, just as a follow-up, a lot of the programs and thoughts that you've been putting out there seem to be hinging primarily on government-led funding. What do you think about the role of private markets, particularly in areas that have been difficult to fund without support, such as alternative energy, and no one seems to have picked up the ball the way that they should have on the infrastructure projects. What kind of incentives do you see might either be necessary, for the private sector to come in and stand alongside government for that?
Thanks for the question. That's very interesting, because we are actually investing in a company that borrows money from the public markets and funds infrastructure development. It's not just a matter of government. The private sector is doing it and is able to do it, and in some cases perhaps do it in conjunction with the government. They certainly did that with the development of vaccine with BARDA and DARPA and biotech for the vaccine development. But the private sector has companies which are able to borrow money at very low cost and then fund alternative development both here and in Europe with entirely private funds. So those opportunities are there, they exist, and those companies, the one that we have an investment in, is generating double-digit rates of return for the shareholders, and it is able to access the capital markets. In fact, one company issued a convertible security without any interest rate. It was a convertible. At the time they issued it, the shares were about 35, I believe, $35 a share. It was convertible at 48, and it was a zero interest rate bond, convertible bond. It took no time at all for the shares to move into the high 40s. But the idea is that And it's a really good point you raised, because when you see a company able to do that, you right away go into the filings, go into all their presentations, see what they have, see what the quality of management is, see what the backgrounds of management, et cetera. And you will find companies that are direct beneficiaries, and you don't have to be dependent. We don't have to be dependent on total government financing. But it's a good question. It's an important question. You
Other
know,
important-
apropos, let me just add one other thing. BP, the old British Petroleum, is redirecting its cash flows into alternative energy. What do you think would happen if BP develops, and I think they will, an important business, and then they decide they're going to spin that business out? And we're going to have an opportunity to examine that and say, they have the expertise. They understand all of this. And look what they've done. And now I can invest in that business as an independent business. So I do the first way I would do it, maybe is to just buy BP stock after they make the announcement. You know what you're going to get. You can figure out the sum of the parts. And the sum of the parts is going to probably be greater than the whole. And so we're going to see these kinds of opportunities unfolding in the next couple of years. Exxon they can't stay the way they are. They're a liquidating asset. Every major oil company in the world is a liquidating asset. They can't replace their reserves. They're too expensive. They are spending their reserves, spending them down. They must diversify. Otherwise, they go into ultimate final liquidation. And that's an opportunity to see where they're putting their money in, what the opportunity is, what kind of earnings and cash flow. Cash flow, very important, they'll develop. And that's the opportunity you have to look at.
Can I follow up on that?
Sure, Duncan, go.
Yeah, actually for years, the European oil majors have actually diversified more than the US guys did. In terms of, if you look at BP and Total, for instance, right? The market's never really given them credit for that. I mean, the market trades these alternative energy companies at one price. It trades the fossil fuel companies at another price. And those companies in Europe that diversified or really made real attempts to do that, I don't really think the market's ever given them much credit for that. So you're saying they're going to give them credit going forward because they're going to do some divestiture events, and that, or how, what's your thesis there?
Well, Duncan, that's a very good point. You're absolutely right. The reason the market didn't give them credit is they were all bureaucratically managed companies. They're all bureaucratically managed. So the thesis is that when they invest in these, if they want to see their valuations improve, they're going to have to consider spinning these companies out and having an independent company. How many times? I would say that our experience is that 95% of all spin outs from companies, 95% of them, if not more, operate differently, have been much more successful. And the argument that managements have always made of those companies is that when we were under the umbrella, headquarters would say, you can't spend money here, we have to spend money there. They would deny the opportunity to have the growth that they would have as an independent company. As an independent company, they were entrepreneurially managed. So in your question, the problem was that they were still not entrepreneurially managed. They were managed as bureaucratic enterprises. And because of that, they never experienced the opportunity they would have experienced if they had been run as entrepreneurs instead of as bureaucrats. And that's why these companies never were able to do what we all think should have been the case.
So Arnold, you're so excited. This is this moment in time in 60 years that you've mentioned, but as Simon Vine, one of our favorite investors, likes to say, what's the contrarian case? He asked Nancy Lazar this question, like what, she said, if the Democrats win, sweep, she said in May, but more secular, what stands in the way? What scares you? Let's put it that way.
Well, the division in the country is so serious, and it manifests itself in the government as well, that we, we can say, we can make the argument that we're just not going to be able to get things done the way we need to. And then we're going to constantly go into a state of greater and greater inequality. Inequality for us is one of the worst conditions that a democracy can possibly face, because when you have inequality, you lose the middle class. And no democracy can be strong if it doesn't have a strong middle class. And then the extremes create violent approaches to solutions, to problems. And that is, for us, a declining middle class is the biggest risk that our country faces, because it manifests itself in every area of activity. And the resentment that's created prevents Americans from coming together, doing the things that they need to do. We can all disagree, but how we disagree is fundamental. And the problem is that, and we've seen it now this year with the stock market, how many people have been huge beneficiaries of what the markets have done, while we have the unheard of long miles, people needing meals, people being threatened with eviction. This is a prescription for disintegration. And that is the biggest single threat that we face, in my opinion. And it's not without a good solution. The solution is a lot easier, but if we continue to go this route, then none of the opportunities we have will do anything but create more disequilibrium, more inequity. And that's a prescription for the loss of democratic values and a democratic system. We're seeing it right now with what's going on with the threats to our institutions, the democratic threats. The Constitution is under considerable pressure. And it's that way because the political system is such that people are more interested in being reelected than in observing their oath of office and doing what's good for the country. So that creates, and whether you're a Republican or a Democrat is irrelevant, because we all can see the problems, we all know what the solutions are. But if we are going to continue to degrade the middle class and to have the inequality among different levels of society, among different types of people, then we're going to have a problem. And that's my long-winded answer to your question of what worries the